Welcome to the deep dive. Today we're taking a look into the blueprint of a major high-end home furnishings retailer. This is a company that has really, since 1986, positioned itself as the definition of livable luxury. They promise the consumer this idea of an absence of compromise, thoughtful materials, and, a dedication to heirloom quality.
It's a remarkable brand narrative. I
Yeah.
mean, it's steeped in the language of craftsmanship and artistry. But our goal today is to look past that carefully constructed facade. We're analyzing excerpts from their 2024 annual report, the 10K. And this document, it lets us see the operational realities behind the brand. It charts their aggressive expansion, but it also reveals some significant financial and internal control challenges.
Right. So our mission for you, the listener, is to really explore the tension between these two worlds. You've got the high-touch, beautiful world of retail on one side, and then the complex and, let's be honest, often messy reality of corporate growth on the other. We want to see how a company built on artistry handles that pressure to scale. Okay, let's pull this apart. So when you dig into their core brand identity, the source material, it focuses so intensely on their direct relationship with the makers. They talk about cutters of fabric and leather, sculptors of wood.
Carvers of stone.
Yeah.
Yeah, it's very poetic. And they're collaborating with artisan partners all over the world. This isn't just picking items off a shelf, they're commissioning them.
And that direct sourcing model seems absolutely fundamental to what makes them different.
It is. It's how they can claim exclusivity, which
Right.
is everything in the luxury space. The sources confirm it. Roughly 95% of their net revenue in 2024 came from products you can only get from them. That just eliminates direct competition on specific items, and it lets them control the price.
And their philosophy about how to show you that product is just as unique. The source material uses these three very strong words.
Retail is theater.
Exactly. Retail is theater.
And that phrase just perfectly captures the whole strategy. I mean, these are not your standard furniture stores. They're positioning their showrooms, the ones in, say, Peachtree City, Georgia, or the Grove in LA, as these immersive experiential destinations. They're built for inspiration, for discovery. They want you to feel like you're in this sophisticated lifestyle setting.
So the goal is to get you to stay there longer and to touch and feel the quality they keep talking about.
hmm And the cost of creating that theater is significant, but it's central to their value proposition. And then there's the human element that completes the play. They really highlight the role of their interior designers in the showrooms. These aren't just salespeople, they are industry-leading professionals.
So they're there to differentiate the brand, solve the client's problems. It sounds like a very high-touch, white-glove service model.
It is, which is fundamentally difficult to scale efficiently.
Right. Speaking of scale, let's shift from the beautiful objects to the aggressive logistics of it all.
Yeah, because 2024 was defined by the largest single-year physical growth in this company's history. It was huge. They completed 16 showroom projects. That's 11 brand new openings and 5 strategic relocations.
Wow, 16 in 1 year. That's a staggering operational lift, and that pushed them past a major milestone, right?
It did. They grew from 92 to 103 total locations across 30 states. They officially hit the 100th showroom mark. They're clearly going after the entire U.S. luxury market.
And they're doing it with two different kinds of stores.
2 distinct formats, yeah. The main engine is the traditional showroom. That's the big immersive location, averaging a massive 16,600 square feet. But they're also using what they call the design studio format. These are much smaller, about 5,400 square feet on average. And they place them strategically in, say, affluent second home markets where a full showroom just wouldn't make sense.
Okay, so if they expanded that aggressively in 2024, what's the end game? Does the 10K say what their vision for maximum penetration is?
It does. And their goal is, well, it's pretty ambitious. They project they can eventually support over 165 traditional showroom locations in the U.S. And to get there, the plan is to keep a pace of about 5 to 7 new traditional showrooms every year.
That raises a really important question, though. If they're so dedicated to this physical retail as theater experience, how does their digital strategy fit in?
The digital side is positioned as, the essential counterpart. It's the omni-channel model. Their e-commerce channel is supposed to be the virtual extension of the showrooms. It's critical for feeding leads into those 103 doors.
Okay, but how is it actually performing?
Well, this is interesting. The source material notes that e-commerce net revenue actually decreased in 2024 compared to 2023. But the company still maintains that over the long term, e-commerce is their fastest growing revenue channel.
Wait, that sounds like a contradiction. How can it be decreasing now, but also their fastest growing?
It really speaks to the volatility in consumer behavior, just how hard it is to maintain that high-touch service digitally. They're trying to bridge that gap with things like virtual shopping tools, direct chat with their interior designers. The challenge is making sure the digital experience delivers the same feeling of quality that the massive physical showroom does.
Okay, so this aggressive scaling isn't happening in a bubble. It's running into some headwinds.
Exactly. It's running headlong into macroeconomic friction, and the financial snapshot for 2024 really shows the strain. Overall net revenue decreased by 1.3%. It fell from almost $1.288 billion down to $1.271 billion.
So revenue is dipping, even just a little, right after their biggest expansion year ever. We have to look at profitability. What happened to their gross margin?
And this is where it gets really interesting. Their gross margin compressed a lot. It decreased by 260 basis points. It dropped from 42% of net revenue down to 39.4%.
Wow. Losing nearly 3 percentage points of margin in 1 year. For a luxury retailer, that's a huge warning sign. Let's unpack the reasons for that, because I bet it links right back to the theater model.
It does. The sources break down the costs very clearly, and they're all tied to that physical footprint. The single biggest hit: increased showroom occupancy costs. They were up $12.9 million. That's the massive fixed cost of maintaining luxury real estate for 103 large locations.
So the cost of the expansion is hitting the balance sheet immediately.
Precisely. And on top of that, you have a higher delivery and transportation costs, adding another $2.6 million. Plus, credit card fees went up by $1.9 million. These are all the expenses of operating a high-volume model during a period of, inflationary pressure.
And the company itself points to external risks that could threaten them in the future, right? I mean, it makes sense they'd be highly sensitive to the high-end housing market. If the stock market drops, demand for a $10,000 sofa just vanishes.
It evaporates, absolutely. And then there's their supply chain. They're relying on a global network: North America, Europe, Southeast Asia. So they are constantly managing constraints and geopolitical risks. A small trade policy change somewhere could immediately impact their ability to get those exclusive materials at a good cost.
And then finally, there's the operational risk of just getting the product to the customer. The sources say they depend entirely on third-party transportation carriers.
Yeah, so any risk to those carriers, labor disputes, bad weather, higher fuel costs, it directly hits their fulfillment expenses. And maybe more importantly, it damages that client service reputation they work so hard to build.
Okay, so now we have to pivot. We've talked about the customer experience. Now let's talk about the nuts and bolts of the corporate back office.
Right, because to compound all these external pressures, the deep dive into the 10K reveals some persistent, long-running internal problems, specifically with financial governance.
You're talking about material weaknesses, MWs in their internal control over financial reporting, or ICFR. And for you listening, these are foundational control failures. This isn't just a simple accounting error, it's a systemic failure to monitor and verify the numbers.
That's precisely right. And the sources really emphasize how severe this is by noting that these weaknesses were still outstanding as of the end of 2024. And critically, these failures led to multiple prior restatements of their financial statements. We're talking from 2019 all the way through 2023. This is not a new problem.
It's a systemic challenge that's been shadowing their growth for years. So let's detail the two major categories they identified. The first one sounds like a staffing issue.
It is, partly. They cited a lack of sufficient accounting personnel, people who know the really technical accounting rules, and ineffective controls over the period-end financial reporting process. So basically, the people on the processes needed to accurately close the books each quarter just weren't sufficient.
And the second category. This one shows a massive disconnect between their fancy virtual shopping tools and their internal systems. It's all about technology governance.
Yes. The second one highlights ineffective controls over information technology general controls, or ITGCs. This is foundational stuff like user access, who can touch the data program, change management, computer operations. Think of it this way. They're building a beautiful 16,000 square foot theater, but the foundation and the alarm system of that building are unreliable.
And the market looks at that. A publicly traded company that's a large accelerated filer struggling to report its own numbers accurately and sees enormous risk. It has to raise skepticism about their entire 165-store growth plan.
That skepticism is warranted. But to their credit, management has responded with a very aggressive remediation plan. Since the end of 2021, they've hired 15 additional technical accounting and financial reporting people, so they know they have a gap to fill.
And what about the processes themselves, not just the people?
They've implemented a formal financial close process. Think checklists, standardized reconciliations. They've also outsourced their internal audit to a third-party firm to bring in expertise fast. But the biggest effort is focused on that IT weakness. They have started a huge company-wide initiative to modernize their IT infrastructure. The goal is to automate a lot of those manual processes and finally strengthen that control environment.
This analysis just gives such a clear picture of all the pressures they're facing. We've looked at a brand defined by artisan quality, we've charted their rapid physical expansion, we noted the pressure on their margins from those rising costs, and now we've drilled down into this critical internal mission to fix their foundational weaknesses.
The contrast is so stark. On one hand, the company has a strong foundation to invest from. They have a debt-free balance sheet, and they're positioning themselves to fund future growth. They're projecting, between $90 and $110 million in capital expenditures for 2025. That money is supposed to fuel the growth towards those 165 showrooms.
But the success of that entire trajectory depends completely on executing those internal administrative fixes. It's like a race between opening new doors and stabilizing the back office. The IT modernization and that accounting remediation plan are absolutely paramount.
The audit findings really reveal that the biggest risk to this brand isn't external, it's internal.
So here's the final provocative thought for you to consider. This company sells physical, tactile, heirloom quality furniture. Their success relies on this high-touch, theater-like retail experience. But given everything we've seen in the source material, does the success of that luxurious sensory world depend entirely on the successful implementation of new accounting software and robust IP controls? Which factor, the visible high-touch consumer experience or the hidden digital corporate infrastructure, will ultimately be the thing that limits or unlocks this luxury brand's potential for sustainable scale?